So if you've turned on a TV or scrolled your feed lately, you've definitely heard the screaming match over the economy. But today, we're doing something totally different. We're stripping away the political noise, the talking heads, and all the campaign spin. Instead, we're diving straight into the math, specifically the 1.2 million objective data points that actually define the Trump and Biden economies, using the absolute latest data we have right through 2026.
Look, depending on who you ask, the last few years were either an absolute economic miracle or a total unmitigated disaster, right? It's the ultimate he said, she said of modern American politics. But we're going to look right past that extreme rhetoric to figure out how these administrations actually impacted the one thing that really matters, your bank account. No red filters, no blue filters, just the raw, undeniable numbers placed side by side.
Here's our roadmap for today. We'll start with a quick reality check, move into the job machine battle, tackle the inflation monster, look at wealth, markets, and debt, and finally, unpack the fascinating psychology of the vibe economy.
All right, part one, the reality check. Stripping away the red and blue filters. Moving into part two, the job machine battle, quantity versus quality.
Okay, let's dive into our first major metric, the labor market. Now, both sides passionately claim to be the unrivaled job creators, right? But when we put the numbers head to head, a much more nuanced picture emerges. The Biden administration oversaw a massive 14.2 million job gain. Now, that was heavily fueled by the post-pandemic rebound as the entire world reopened, plus a period of high immigration. But to be completely fair to the math here, even after that initial rebound, Biden maintained a really steady average of about 300,000 jobs created every single month. Fast forward to Trump's early 2026 data, and we're seeing a remarkably different story, a pretty significant labor slowdown. And this number perfectly illustrates the pattern interrupt we're seeing right now, just 24,000. That is the average monthly job growth in early 2026 under Trump. It's a massive drop-off.
So what's happening? Well, the data points to two main culprits, a generally cooling labor market and a sharp decrease in immigration levels. Remember, economists noted that immigration acted as a primary fuel for that rapid job growth we saw during the Biden era. So it's this classic economic tug-of-war between sheer recovery numbers and market stabilization. Which brings us to part three, the inflation monster, supply chain versus policy.
All right, next up is arguably the single most painful metric for everyday consumers under both presidents, the sheer cost of living. And frankly, this is where the math gets genuinely uncomfortable. During the Biden years from 2021 to 2025, inflation hit a brutal peak of 9.1%. And yeah, even though it eventually cooled down toward 3% by the end of his term, the structural damage to our wallets was already done. Prices didn't magically drop back down, they just stopped rising quite so fast. Overall, prices rose 21.5%, while wages only crept up 19.9%. That gap, it meant a really painful 1.3% drop in real purchasing power for the average person. Basically, your paycheck literally bought less at the grocery store.
Now contrast that with Trump's early 2026 data. He campaigned hard on ending that inflation nightmare, but under his new tariff policies, combined with ongoing geopolitical tensions in the Middle East hitting the global oil supply, energy prices alone have suddenly jumped by 12.5%. So the big takeaway here is that consumers are facing what essentially amounts to a pick-your-poison scenario. Under Biden, we got hammered by post-COVID supply chain inflation. Under Trump, we're now dealing with policy-driven and tariff-related price hikes. The specific triggers for the inflation changed completely, but that persistent squeeze on your wallet, that remains a central, unavoidable theme.
Let's shift gears to part four, wealth, markets, and debt, the credit card economy. Okay, so for this round, we're looking at the wealth factor. We're talking about a historically booming stock market going head-to-head against our absolutely exploding national debt. Surprisingly, despite all that inflation friction we literally just talked about, the math shows the stock market totally thrived under both presidents. Biden saw the S&P 500 hit dozens of all-time highs throughout his term. Fast forward, and Trump is hitting brand new record highs in April 2026. This recent market surge under Trump is heavily driven by investors cheering ceasefire news, along with his 2025 tax cut, the One Big Beautiful Act, which pumped an extra $40 billion in tax refunds straight into the American economy compared to the previous year.
But man, when we look at the national debt, reality hits hard. The one thing both administrations completely agree on is swiping the national credit card for trillions of dollars. Biden added roughly $8.4 trillion during his term. Trump in his first term added $7.8 trillion. Their spending habits are almost mathematically identical when you get right down to it. And here is the truly gasp-inducing math for you. In 2026, we are currently adding to that national debt at a staggering rate of $5 billion every single day. Just let that sink in for a second. $5 billion a day in debt, absolutely regardless of which political party is sitting in the Oval Office.
All right, let's bring it home with part 5, the vibe economy, math versus feelings. This is where things get super interesting. We're exploring this fascinating disconnect between the hard, raw data we just reviewed and how human beings actually experience their financial reality. Enter the vibe economy. It's a psychological phenomenon we've been tracking over the last few years. It's defined as the disconnect between objective mathematical economic metrics and the subjective financial sentiment of the public. Basically, it explains why having strong macroeconomic numbers, like low unemployment or steady GDP growth, doesn't always mean the public actually feels confident or wealthy. Sometimes the math on paper just doesn't match the feeling around the kitchen table.
And we can see exactly how this plays out step by step. Under Biden, the baseline math was honestly pretty solid. We even saw 2% GDP growth stretching into early 2026. But people overwhelmingly felt poor because of that intense cost of living friction at the grocery store. On the flip side, under Trump, the underlying math is showing some real cracks, like slower job growth and higher energy inflation. Yet, small business sentiment is absolutely soaring because of the promise of deregulation and tax cuts. Think of it like this. Biden built the factory with major infrastructure projects like the CHIPS Act, and Trump is now stepping in to aggressively deregulate the factory floor.
Ultimately, when we look at all 1.2 million data points without any filters, the math shows there isn't an objective, undisputed winner here. It's essentially a tie, and it depends entirely on what you personally prioritize in your own life. If you value a robust, high-volume labor market and heavy infrastructure investment, then the Biden statistics are absolutely going to appeal to you. But if you prioritize lower taxes, corporate deregulation, and rapid stock market gains, well then Trump's data aligns perfectly with your financial goals.
As we wrap up this explainer, I really want to leave you with a provocative thought to chew on, based purely on the math we've just explored together. Looking right past the noisy headlines, ignoring all the political spin, and focusing entirely on your own daily life and budget. Does your bank account feel more like a Biden boom or a Trump triumph right now? The math is out there for everyone to see, but the vibe? Well, that's entirely yours. Thanks so much for joining me to explore the data, and as always, keep questioning the numbers.